All right, so in this section, I'm going to show you how to manage risk through position sizing as well as using stop orders. Risk management is definitely an important element to trading. It's one of the most important elements, and any trading strategy that you use should have a risk management component. So here's an example of a trade. I did buy the dip over in this area right here. And so here's a couple of ways you could handle this. As we can see here, we have a reversal candle, so nice long tail, right? Shows that buyers are in control. So one could scale in here because there's prior resistance turn support, so it's kind of a good area. So one could scale in perhaps partial position size, let's say 25% of whatever position you want. And to manage risk, let's say the markets fail and that's not the bottom and the market rolls over, you could set a stop order down here to get yourself out of that trade. You want to be able to kind of set targets ahead of time. So if you were to buy here, and let's say you have your initial target as prior resistance, and you set your stop there. So this is a 3-to-1 ratio. So you come in 25% here. If it rolls over on you and it breaks down, then you're only losing 16% of a quarter of what you were going to put into the trade. So you assess the size of your trade ahead of time. How much do you want to put on the line in this trade, and assess the risks ahead of time, right? So this would be an initial entry. Then you could add to that position on confirmation. So for example, if it bounces and then we have another breakout here, perhaps you could add to your position another 25%. Then as it makes a higher low, perhaps creating a trend line or a bull channel, you could add to your position again on the dip, another 25%. And as it breaks out and confirms yet again, so let's say we have this immediate bull channel right here, and you could do this on spot. If you were to just buy Bitcoin on spot, that would be the least dangerous. If you are swing trading on margin, then it's important to go easy on the leverage. If you go too heavy on the leverage, you don't have a lot of wiggle room. So max leverage that I use for swing trading is 3x. So here's a breakout right there. And as you can see, could add the remaining last part of the position. So this would be a way of, this is called pyramid trading, a market. So, you have a nice early entry, and as you have confirmation of the trend going in your favor, you scale in increments. Then you could also do the same as far as scaling out, right? So you could take some profit off of the table here as it hits resistance, but then as it breaks out, you could enter into a whole new trade and pyramid trade again, perhaps re-adding to your position or even a larger position or another trading position, right? If it goes in your favor, and then you can essentially take target up here and use or take profit at this target up here. If you were to use a Fibonacci extension, you can see that resistance 1.618, resistance is right here. So obviously you can look to take profit, start scaling out in increments, perhaps sell 25% over here. And then when it goes parabolic, sell into strength. And as it breaks down, close out the rest of your position. So you could also use what's called a trailing stop to close out your position as the market moves against you. You can calculate what percentage you want that to happen at. So this is basically a potential swing trading scenario and how you would manage risk on this. If you were to look at risk to reward from this level, that's pretty much a double from the initial entry point. So that's position sizing through pyramid trading. Let me show you position sizing and accumulation, right? which basically involves cost averaging down. So as you can see here, it had made a new low and we created a range, an accumulation range. So if you wanted to accumulate this, let's say throughout 2015, you could essentially just set some Fibonacci retracements. And just cost average down at various different levels throughout the year, right? The further down it goes, the more you buy. So that's one way of accumulating, right? Position sizing through cost averaging down. You can do this on altcoins. So let me show you an example with an altcoin. All right, so here's Ethereum. Let's just use a fib extension. So let's say you were to buy at the sweet spot and start accumulating right here. If you wanted to accumulate this, you could go in partial position size, let's say 25%. Then as it breaks down, you could scale in again, another 25%. You could have an order down here just in case it breaks down more and just scale in increments. And then you can combine that with pyramid trading if it goes in your favor and you start to see a breakout. So let's say you don't have your entire position yet as you cost average down. You got 25, 25, and it doesn't go lower, breaks out, you add 25, and then you can even go another 25 over here. See, this is just as a hedge, right, in case it continues to break down. And then as it bounces, you'll end up in profit. So your cost basis will be down here, and as it bounces, you'll be up in profit. So this is one way of accumulating and cost averaging down through accumulation. So that's it for this section for risk management through position sizing and using stop orders, and we'll see you in the next. Cheers.